$13.7 trillion. That's the total outstanding corporate debt in America, according to Federal Reserve data. Not government debt, corporate debt, money that American businesses owe to bondholders, banks, and private lenders. And if you think corporate debt levels don't affect you personally, I need you to understand what happens when that debt can't be serviced. Because over $1.8 trillion of that debt matures in the next 2 years. Money borrowed when interest rates were near zero that must now be refinanced at rates 3 to 4 times higher. Companies that could afford their debt payments at 3% cannot afford them at 8%. The math doesn't work. And when the math doesn't work, defaults follow. The default wave isn't a prediction. According to S&P Global, it's already beginning. While you were watching the stock market hover near all-time highs, something ominous was building beneath the surface. Corporate bankruptcies in 2024 reached their highest level since 2010, according to S&P Global data. Not during a recession, not during a crisis, during what officials called a resilient economy. These aren't small businesses. Failing major corporations with billions in revenue are filing for Chapter 11. Retailers, healthcare companies, media conglomerates, real estate firms. And this is just the beginning. The maturity wall, the wave of corporate debt coming due for refinancing, peaks over the next 24 months. Over $600 billion in high-yield debt alone must be refinanced or repaid. When companies can't refinance, they default. When they default, bondholders lose money, employees lose jobs, suppliers don't get paid, pension funds holding corporate bonds face losses. The ripple effects spread through the entire economy. Your 401k likely holds corporate bonds. Your employer likely carries debt. Your job likely depends on companies that depend on companies carrying this debt. The $13 trillion bomb isn't abstract. It's wired into the financial system you depend on. Now, let me be precise about sources before we continue. I'm drawing from Federal Reserve financial stability reports, S&P Global default studies, Moody's credit analysis, SEC corporate filings, and academic research on credit cycles. These aren't fringe sources. These are the rating agencies and institutions that track corporate credit professionally. Their data is what banks use to make lending decisions. I'm not predicting economic apocalypse. I'm presenting documented debt levels, historical default patterns, and what credit analysts themselves are warning about in their published research. The data is public. The maturity schedule is documented. The math is arithmetic. By the end of this video, you'll understand exactly how the corporate debt bomb was built, why it's detonating now, and what historical precedent tells us about what happens when corporate defaults cascade. Because here's what most people don't realize. Corporate debt crises follow predictable patterns. They don't arrive randomly. They build during periods of easy money, mature during periods of tight money, and cascade when refinancing becomes impossible. There's a documented cycle here, a cycle that's played out multiple times in recent decades. Same stages, same warning signs, same devastating impact on employment, pensions, and economic stability. The 2001 default wave, the 2008 default wave, the 2020 default wave. Each followed the same pattern. Each was preceded by the same indicators we're seeing now. The only question is whether you understand what's developing while there's still time to evaluate your exposure, or whether you'll recognize it only after the defaults make headlines. Stay with me. The next 15 minutes will reveal what credit analysts are seeing that the headlines miss. To understand why corporate defaults are accelerating, you need to understand how corporate debt cycles work, not the simplified version, the actual mechanics that repeat with remarkable consistency. Every major corporate default wave in modern history has followed a predictable 4-phase pattern. Phase 1. The easy money buildup. Central banks lower interest rates, making borrowing cheap. Corporations issue massive amounts of debt at low rates. Money flows freely. Credit standards loosen. Companies that couldn't borrow before suddenly access bond markets. This phase typically lasts 5 to 10 years. Debt accumulates, leverage increases. But low rates make payments manageable. Everyone focuses on growth, not sustainability. Phase 2. The zombification. Companies become dependent on cheap debt to survive. They're not profitable enough to service debt at normal rates. But rates stay low, so they keep rolling debt over. These zombie companies proliferate. Studies suggest 15-20% of public companies become zombies during extended low-rate periods. This phase lasts until rates rise. The zombies appear healthy because they can make payments, but they're surviving on financial life support. Phase 3. The rate shock. Central banks raise rates. New borrowing becomes expensive. Old debt matures and must be refinanced at higher rates. The math that worked at 3% fails at 8%. Companies face a choice: find new capital, cut costs dramatically, or default. This phase lasts 12 to 24 months as the maturity wall arrives. Phase 4. The default cascade. Companies that can't refinance begin defaulting. Defaults create ripple effects. Suppliers don't get paid. Lenders tighten standards further. Credit becomes even scarcer. More companies default. The cascade accelerates. This phase determines whether the economy experiences a manageable correction or a severe recession. Now let me prove this pattern is real. 3 examples. 3 default cycles. Same phases each time. 2000 to 2002. The dot-com default wave. This example matters because it shows how quickly corporate debt crises develop once rate conditions shift. Throughout the late 1990s, capital flooded into corporate America. Companies issued debt at attractive rates. The tech boom created appetite for corporate bonds across sectors. Phase 1. Easy money buildup. Corporate debt grew approximately 50% during the 1990s. By 1999, thousands of companies were burning cash, unprofitable, but sustained by continuous access to cheap capital. They could service debt because they could always raise more. Phase 2. Zombification. Companies surviving on capital markets rather than profits. Then the Fed raised rates. The dot-com bubble burst. Capital markets froze. Companies that needed to refinance couldn't. Phase 3. Rate shock colliding with evaporating credit access. The default wave was dramatic. Enron collapsed with $63 billion in assets. WorldCom filed the largest bankruptcy in history at that time. Hundreds of companies defaulted. High-yield default rates spiked to over 10% in 2001 and 2002. For every $100 of junk bonds, $10 defaulted in a single year. Phase 4. Default cascade affecting the entire economy. The 2001 recession wasn't caused solely by corporate defaults, but defaults amplified the downturn. Millions lost jobs. Pension funds holding corporate bonds faced losses. The economic damage extended years beyond the initial shock. Pattern established. Easy money, zombification, rate shock, default cascade, 2007 to 2009, the financial crisis default wave. This example matters because it demonstrates how corporate defaults interact with financial system stress, amplifying damage beyond what debt levels alone would suggest. Following the 2001 recession, the Federal Reserve cut rates dramatically. Borrowing became extraordinarily cheap. Corporate debt issuance accelerated. Phase 1. Easy money at historic extremes. By 2007, corporate leverage had reached record levels. Private equity firms loaded companies with debt for leveraged buyouts. Credit standards deteriorated. Covenant-light loans, with fewer protections for lenders, became common. Phase 2. Zombification through financial engineering. Companies weren't just borrowing for operations. They were borrowing to fund stock buybacks, special dividends, and acquisitions. Debt levels grew faster than business fundamentals. Then came 2008. Credit markets froze completely. Companies couldn't refinance regardless of rate. Access to capital disappeared. Phase 3. Not just rate shock, but complete credit market failure. The default wave was devastating. High-yield default rates exceeded 13% in 2009. Major corporations with decades of operating history collapsed. General Motors, Chrysler, Lehman Brothers, hundreds of others. Phase 4. Default cascade became systemic crisis. The damage extended far beyond defaulting companies. Unemployment peaked at 10%. Housing prices collapsed. Retirement accounts were devastated. The economic impact lasted a decade. The 2008 crisis demonstrated that corporate defaults don't occur in isolation. They interact with financial system stress, creating feedback loops that amplify damage. Pattern confirmed. Same phases. Amplified by financial system linkages. The COVID default spike. This example matters because it shows how quickly defaults accelerate when conditions shift, and how policy intervention can temporarily mask underlying problems. By early 2020, corporate debt had reached new records. A decade of near-zero rates had encouraged massive borrowing. Corporate debt exceeded $10 trillion, up from $6 trillion in 2010. Phase 1 and 2. The longest easy money period in history created unprecedented zombification. March 2020. COVID hit. Revenue collapsed for many sectors. Companies faced debt payments without income. Phase 3. Shock, though from demand collapse rather than rate increases. Defaults spiked immediately. Over 200 major companies filed bankruptcy in 2020. Retail chains, energy companies, airlines, entertainment venues. High-yield default rates jumped to nearly 7% within months. Phase 4 beginning. Default cascade starting. Then the Federal Reserve intervened at unprecedented scale. They cut rates to zero. They purchased corporate bonds directly for the first time in history. They flooded markets with liquidity. The intervention arrested the default cascade. Companies that couldn't access private markets borrowed from Fed-supported facilities. The crisis was paused, not resolved. And here's the crucial point. The intervention didn't reduce debt. It increased debt. Companies borrowed more to survive 2020. Total corporate debt grew even larger. The Fed bought time. They didn't fix the underlying problem. The zombie companies survived. The debt accumulated. The maturity wall was pushed back, not eliminated. The 2020 intervention delayed the reckoning. It didn't prevent it. 3 cycles, same pattern. The current situation follows the same trajectory, but with debt levels exceeding any previous cycle. Now I know what some of you are thinking. Let me address the counter-arguments directly. But the economy is strong. Companies are profitable. Many companies are profitable. Many are not. The zombies don't show up in headline economic data. And profitable at low interest rates isn't the same as profitable at current rates. Companies reporting profits in 2022 may report losses in 2025 with identical operations, purely due to interest expense increases. The strong economy narrative relies on aggregate data that masks weakness in debt-stressed sectors. But the Fed can cut rates and solve this? Perhaps. But consider, the Fed raised rates to fight inflation. Cutting rates before inflation is controlled risks reigniting price pressures. And even if the Fed cuts, will they cut enough? Returning to zero rates seems unlikely. If rates settle at 3 to 4%, companies that need 1 to 2% rates to survive still face problems. The Fed can provide relief. They probably can't provide rescue at the scale needed without reigniting inflation. But companies will just refinance. They always do. Companies refinance when lenders are willing to lend. When default rates rise, lenders become cautious. Credit standards tighten. Refinancing becomes harder precisely when it's most needed. The assumption that refinancing is always available assumes permanent credit market confidence. History shows that confidence can evaporate rapidly. But defaults are normal. The economy handles them. Moderate defaults are normal. The system absorbs individual failures, but default waves at cycle turning points are different. They create feedback loops. They trigger recession dynamics. They destroy jobs and wealth beyond the defaulting companies themselves. The question is magnitude. Current debt levels suggest potential magnitude exceeding recent cycles. But this has been predicted before and didn't happen. Correct. The 2020 intervention delayed the reckoning. The 2023 banking stress was contained. Each time the bomb didn't explode. But each intervention increased debt rather than reducing it. Each delay pushed maturity walls back rather than eliminating them. The bomb grew larger with each diffusal. Previous non-explosions don't prove the bomb is fake. They may prove the fuse is longer than expected. So what does this mean for you? Practically, specifically. Right now, I'm not a financial advisor. I can't tell you what to do with your money, but I can share what the credit data suggests and what historically informed observers consider during default cycles. First, understand your corporate bond exposure. If you hold bond funds, check their corporate exposure. High-yield bond funds carry default risk by definition. Investment-grade funds carry less risk but aren't immune. Target date retirement funds typically include corporate bond exposure. Know what you own. Second, evaluate your employer's debt situation. Public companies file financial statements. Check your employer's debt load, interest coverage ratios, and upcoming maturities. Companies with heavy debt loads may face restructuring that affects employment. Understanding your employer's financial position isn't paranoia. It's prudent planning. Third, consider your customer and supplier concentration. If your business depends on heavily indebted customers or suppliers, their default affects you. Diversification of business relationships provides resilience. Fourth, watch the leading indicators. Default rates reported by S&P and Moody's. Credit spreads, the gap between corporate and treasury yields. New issuance volumes in corporate bond markets. Bankruptcy filing data. These metrics provide early warning of accelerating stress. Fifth, recognize the employment implications. Corporate defaults mean layoffs, restructurings mean downsizing, economic stress means job market weakness. This may not be the time for maximum financial leverage in personal life. Emergency funds, reduced personal debt, and marketable skills provide resilience regardless of whether the corporate debt bomb explodes or fizzles. Sixth, understand the pension implications. Pension funds hold corporate bonds. State and local pension funds, already underfunded in many cases, would face pressure from a corporate default wave. If you're depending on pension income, understanding your fund's corporate exposure and funded status matters. If this analysis provided value, subscribe to The Silent Economy and hit the notification bell. I release new research weekly, and the next video breaks down exactly which sectors face the highest default risk, which companies show warning signs in their filings, and how previous default cycles affected employment and investment returns. Drop a comment below. Tell me what you're seeing in corporate debt markets, whether you're concerned about specific sectors, what questions remain about how this affects you personally. I read every comment. This channel grows through engaged discussion with people who recognize that the most important economic developments often hide in financial statements rather than headlines. 24s, 2430. Here's what I want you to remember. $13.7 trillion in corporate debt, $1.8 trillion maturing in the next 2 years. Interest rates that make previous debt levels unsustainable for many borrowers. This isn't prediction, this is arithmetic. The pattern has played out before. 2001, 2008, 2020. Each time debt accumulated during easy money. Each time stress emerged when conditions tightened. Each time defaults cascaded until intervention or recession cleared the excess. Current debt levels exceed any previous cycle. Current rate levels make previous financing impossible to maintain. The pattern suggests the cycle is reaching its critical phase. Maybe intervention saves the day again. Maybe rates fall fast enough. Maybe the zombies find a way to survive. Or maybe the math catches up with companies that borrowed beyond their capacity to repay. The data is public, the maturities are scheduled, the pattern is historical. Thanks for watching The Silent Economy. And remember, the people who navigate credit cycles aren't always the ones with the most assets. They're the ones who understood the debt dynamics before the defaults made headlines. The filings are public. The maturity wall is documented. The choice to pay attention is yours.